So let's look at a retirement income scenario using whole life insurance. And here I'm following on the example that I did in part 4 of the Infinite Banking Concept Explainer series. So if you haven't watched that video, watch part 4 first, otherwise you won't have the context for this video. So this here is just kind of rehashing what we did in that particular example. We took out 3 whole life policies, converting our term to whole life over the course of a few years. And by the time we reach retirement age, we now have $3 million in cash value and $5 million in permanent death benefit. Now, this whole time we can be utilizing this money, this cash value, without interrupting interest and dividends being paid. And that's very important to understand. So we're not locking our money up somewhere where we can only use those dollars once, right? Even if the dollars were, let's say, in a savings account where it's liquid and accessible to us, as soon as we withdraw money from that savings account, we're no longer earning on those dollars. That's not the case here. We can use the money while the money keeps earning for us, thanks to the very unique policy loan feature. So that's not depicted here. We're just showing the cash value and death benefit buildup, but it's important to understand that you can be using this money without interrupting the buildup. So over the course of roughly 30 years, from age 35 to age 65, by running our cash flow through these whole life policies, we've now built up a total of $3 million of cash value and a $5 million permanent death benefit, which obviously will pay out upon our death when we die, can be accessed in the case of long-term care or a terminal illness. And the cash value, of course, is liquid and accessible to us via a policy loan, so we can borrow against the policy without taking on debt, without interrupting the growth in the policy, while we're still earning on the entire principal balance. And all of this is, of course, tax-free. So let's dive a little bit deeper into the retirement income scenario, which we did show in the previous video, but I want to go a little deeper into showing again how whole life insurance is a two-dimensional asset. So just like I mentioned before, we can be using the cash value while the cash value keeps earning for us. So this is kind of showing that same scenario, but now projecting it out even further. So this is showing you the working years up to age 65, what we showed on the previous slide, where we had $5 million in permanent death benefit and $3 million in cash value by the time we reached age 65. And this is showing you what it will look like in retirement. But notice here what I'm showing you also, income. Okay, we are taking income of $124,000 a year from this policy over the course of 20 years, which means we take $2.5 million of income cumulatively out of the policy, tax-free, without taking on any market risk, over the course of 20 years of retirement. So we started with $3 million in cash value. What does that do to our cash value? Notice our cash value went up over the course of those 20 years. Our net cash value went up from $3 million to $3.5 million. So our cash value keeps rising even as we're drawing income. And I'm just showing here the net cash value, not the gross cash value, because when we borrow against the cash value using a policy loan, we only reduce the net cash value available to us, similar to the way when you borrow against your house, you reduce the net equity available to you, but you do not reduce the value in your home, and you do not interrupt any rental income that you might be collecting on that house in the meantime. Same thing here. Even while we're borrowing against the policy strategically to generate retirement income, we continue to benefit from capital appreciation in the value of the house. That's the interest. That's guaranteed contractually. And we collect rental income. That's the dividend we're collecting. All that continues uninhibited. But even our net cash value grows, even as we're pulling retirement income from the policy by borrowing against it strategically. And our death benefit is now at about $4.8 million, so our net death benefit hasn't moved very much either. So again, we took $2.5 million of tax-free retirement income out of this policy, and we haven't even really nicked the total value of the policy. That's what's so important to understand. When you have $3 million in cash value, in a seasoned whole life policy, you can really mentally double that number. Why? Well, I'm showing you right here. We have $3.5 million in cash value left over, okay? And we took $2.5 million in income out of the policy. So $3.5 million plus $2.5 million equals $6 million in total cash benefits we got out of the policy tax-free, and yet we only started with $3 million. How did we do that? Because whole life insurance, properly structured, is a two-dimensional asset. We can utilize the capital in the asset while the entire asset base keeps earning for us. So again, from starting with only $3 million in cash value, we derive a total of $6 million in tax-free cash benefits without taking on any market risk, not to mention still a residual $4.8 million death benefit, which not only pays out as a legacy to our heirs when we die, but also covers us in the event, a not unlikely event, of having long-term care needs late in life or being diagnosed with a terminal illness.